Succession planning mistake number 8. The failure to minimize the tax consequences arising from a change of ownership from the owner's death or disability. See, there's always taxes out there, right? How are you going to transfer the ownership, whether to the family, or whether you're going to transfer ownership to key people, or whether you're going to sell the company to an outside company, a competitor, if something happens with the death or disability of a key person? I have one guy I consulted with. Again, I always tell you what happened last year because this stuff comes up all the time. He went out and got a lot of seed money, developed this company. I guess they have $10 million in sales. He's a part-time, he's a minority owner. He owns maybe 20% of the company. But he went out and got all this capital and got through the recession. He got some venture capital. They're wanting to cash him out. They want to sell the company. It's kind of interesting. $10 million in sales, and he's the only salesperson. How would that affect you if you were buying the company? Another client, a number of years ago, 80% of his business was with one bank. How would that affect you if you were going to buy the company? In fact, it was a $15 million deal, and the buyer backed out a week before the deal. The guy was devastated, couldn't take it emotionally. Thought he went the lottery, and he lost it, just like that. He was bankrupt 2 years later. I went out there to do an audit. He was in Arizona. He was from Cincinnati. I did an audit, IRS audit, because he was making too much money. They thought he was money laundering. He was making $3 million a year. That business went under when he lost his, because of then he didn't have attention to the business. The key person had stepped into his shoes, didn't care, and he went under. This stuff happens. This is why it's important in a succession plan. And I look at it not just typically for your family and yourself and your spouse or whoever, but also your employees. It's got to be a win-win. Okay. So when you do that, whatever plan you develop, you want to structure it in a way. What we normally try to do is we try to put the deal together. Then we try to say, how do we get the same result and get a better tax consequence? I'll give you an example. Client was selling his business for $10 million. I'm a tax guy, so I said, look, you got equipment on the books, you're a manufacturer, $6 million, but you've depreciated it. Your tax basis is $600,000. If you sell the company and the equipment is sold for $6 million, you have ordinary income. It costs you 20% more in tax. Same paying capital gains at 15%, you pay personal income tax rates at that time at 35%. So when you do the contract, you say, I'm going to sell the assets for their book value, $600,000. This is mutually agreed upon. That price is contingent on that. They signed the deal. Then the buyer's accountants looked at the deal and said, oh, my goodness, we don't get to write off those assets. We got to write off the goodwill over 15 years. We don't get a 5 or 7 year write-off for the equipment. The client held his ground, and he saved $1 million in taxes on the deal. That's where you do the tax planning. Sometimes people go forward and they don't work with their accountant, quite frankly, and they do it after the fact. And then they lose in the long run. So you want to make sure before you sign a contract, when you're in the period of negotiation, you should be considering the tax consequences if you're selling the company. It's very important to get some strategy there.